Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about American Shared Hospital Services quarterly report. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. American Shared Hospital Services offers a range of technology solutions for advanced radiation therapy equipment and services. At the core of their offerings are leasing options for specialized medical equipment, including 9 gamma knife systems and 1 proton beam radiation therapy (PBRT) system. In addition to leasing, the company provides comprehensive support services such as planning, installation, reimbursement, and marketing assistance. This enables healthcare providers to efficiently integrate these advanced technologies into their treatment centers. The company also owns and operates 2 single-unit gamma knife facilities that offer direct radiosurgery services to patients. By providing both equipment leasing and operational services, American Shared Hospital Services streamlines the process for cancer treatment centers, health systems, and cancer networks worldwide. Their solutions cater specifically to the needs of these organizations, allowing them to focus on delivering high-quality patient care while leveraging the latest advancements in radiation therapy technology. With a presence spanning over 4 decades, American Shared Hospital Services has established itself as a trusted partner in the medical industry. The American Shared Hospital Services (AMS) stock has experienced a significant decline over the past year, dropping by more than 33%. This downturn can be attributed to several key events that have raised concerns among investors. One of the main factors was the company's disappointing financial results, particularly in its Q4 2024 earnings and Q1 2025 net loss. The company reported a loss per common share of $0.20 in Q4 2024, which fell short of analyst estimates. This was followed by a net loss of $625,000 in Q1 2025, with an EPS of -$1.10 that missed forecasts. Although the company saw a year-over-year increase in overall revenue, this growth was driven primarily by direct patient services, while leasing revenue declined. The situation worsened when the company disclosed a covenant default under its fifth third credit agreement due to failing to maintain $5 million in unrestricted cash as of September 30, 2025. This raised substantial doubt about the company's ability to continue as a going concern and led to the reclassification of debt from long-term to current liabilities. However, despite these negative developments, the stock price showed some resilience, with an increase of 1.42% on January 2, 2026, following the announcement of the covenant default. This suggests that investors may be cautiously optimistic about the company's operational improvements and strategic initiatives, such as international expansion. Nevertheless, the overall decline in the stock price over the past year remains a significant concern for investors. The primary drivers of revenue growth or decline can be identified through a review of key events and trends. On the growth side, significant acquisitions such as SNERCC and RWRT have contributed to increased revenues. The establishment of new facilities in Mexico and expansion into new markets through subsidiaries have also driven growth. Additionally, upgrades to existing gamma knife systems and the formation of new subsidiaries have generated additional revenue streams. On the decline side, changes in depreciation expense and capital expenditures related to operations in Puebla, Mexico have contributed to decreased revenues. The decrease in leasing revenue and PBRT services revenue due to lower volumes has also had a negative impact on overall revenue. Furthermore, the increase in transaction costs associated with acquisitions has added to the decline. Overall, these factors highlight the importance of strategic acquisitions, market expansion, and operational efficiency in driving revenue growth, while also emphasizing the need for careful management of expenses and capital expenditures to mitigate potential declines. The analysis of net income and profit margins reveals significant changes over the 3-month and 9-month periods ended September 30, 2025. For the 3-month period, net income decreased by $10,000, primarily due to a change in estimate of salvage value for gamma knife units. However, this decrease is consistent across multiple pages, indicating a deliberate accounting adjustment. In contrast, the 9-month period saw an increase in net income, rising from a loss to a gain of $4,436,000. This turnaround was likely driven by improved operational performance and cost management. Profit margins also showed mixed results, with total costs of revenue decreasing by $44,000 for the 3-month period, but increasing by $2,906,000 over 9 months. The reasons behind these changes are multifaceted. The decrease in net income can be attributed to a change in estimate of salvage value for Gamma Knife units. Additionally, the negative impact on profit margins due to debt and potential default under the credit agreements is a significant concern. These factors highlight the need for careful financial management and strategic planning to mitigate risks and optimize performance. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. As per the latest data available, the company has generated positive operating cash flow of $3,802,000 for the 9-month period ended September 30, 2025. This is a clear indication that the company's business model is generating sufficient cash to cover its operational expenses and invest in growth initiatives. This achievement is a testament to the company's efficient management practices and its ability to optimize its resources. The positive operating cash flow also provides the company with the necessary liquidity to meet its short-term obligations, reduce debt, and pursue strategic investments. Overall, the company's financial health has improved significantly, positioning it for future growth and success. The company's debt level has undergone significant changes over the past year. Initially, the reclassification of $8,631,000 from long-term debt to current liability contributed to a notable increase in debt levels. However, this was followed by a decrease in long-term debt by $2,098,000 from December 31, 2024 to September 30, 2025. In terms of interest expenses, there has been an upward trend. The potential acceleration of payment obligations under credit agreements led to increased interest expenses. Furthermore, the company reported higher interest expense for both the 3-month and 9-month periods ended September 30, 2025, with increases of $56,000 and $183,000 respectively. Overall, these changes suggest that both debt levels and interest expenses have undergone significant shifts over the past year. Management is optimistic about the company's outlook, with several key initiatives underway. One of the most significant developments is the expansion of proton beam radiation therapy, which is a crucial part of the company's strategy. This growth area requires substantial investment, which may impact liquidity and capital resources in the short term. However, management believes that this investment will pay off in the long run as it drives increased procedure volume and revenue through leasing and direct patient services. The company is also expanding its international presence through subsidiaries in Mexico, Peru, and other countries, further diversifying its operations and increasing its global reach. Overall, management's strategy focuses on growth and expansion, both domestically and internationally, with a strong emphasis on investing in key areas that will drive future revenue and profitability. The company's financial strategy has been focused on growth and expansion rather than distributing profits to shareholders. As a result, the company has chosen not to pay dividends to its investors. Additionally, it has also refrained from buying back its own shares, instead opting to reinvest in the business to drive further growth and development. That concludes the financial summary for American Shared Hospital Services. Feel free to comment below, and I will be happy to answer them when possible.